Good morning, everyone, and welcome to this webinar on CGT. My name is Leonie Webster. I'm a partner with Deloitte's Real Estate Tax team. Just before we get into the webinar itself, a couple of housekeeping points. Firstly, if you'd like to ask a question throughout the webinar, please use the Q&A panel. And also the webinar will be recorded and shared with members after the event. So today's topic is capital gains tax, and what we want to do today is to make this session very informative, but also very practical as well. So we're going to cover two broad topics. Firstly, we're going to run through some of the recently announced changes to the legislation. So that's your informative part. And then secondly, given we're actually amazingly nearly 2 years into the NRCGT regime, I know time really does fly, even in lockdown. We're going to try and look and sort of pause really and look at the practical aspects of this, you know, how we've found operating within the regime, the things to think about, the pitfalls and the challenges that we've faced. So to help me do that today, I'm joined by three speakers, stroke panel members. So firstly, Wayne Strangwood from HMRC. Wayne is the HMRC Policy and Technical Lead, Collective Investment Vehicles. Also Christopher Austin, Head of Tax Private Assets at Schroders and Chair of the AREF Tax Committee. And finally, John Poulton, Head of Real Estate Tax at M&G. So we can just turn to the agenda slide. We're going to spend a few minutes initially just resetting the scene, just giving everybody a brief reminder, particularly of the exemption and transparency regimes, but really focusing in not so much on the technical detail, but on the practical aspects of that. You know, what you need to think about. What are the practical elements of operating within these regimes? Wayne's then going to spend a few minutes talking about the recently announced changes. And then finally, actually for the bulk of the session, we're going to have a Q&A. We're going to have a panel where I will be putting your questions to John and Wayne and Christopher. Again, really focusing in on some of the technical aspects, obviously, but also the practical aspects of these regimes. So do ask your Q&A through to us. So if we can turn on to the next slide, which is, you know, the NRCGT core and civ provisions. I'm hoping that everybody is now aware that when you sell UK real estate, there is a charge, regardless of whether you're non-resident or not. And the same applies, obviously, when you sell UK real estate rich entities, where you're selling a substantial indirect interest, which is 25% or more. Again, hoping that everybody's also aware that that 25% gets switched off where what you're selling is a collective investment vehicle. So that means that if you're selling a collective investment vehicle that is UK property rich, even if you're selling a very, very small interest, that, you know, potentially could be subject to tax, and there will be filing requirements as well. Now, Wayne's going to talk in a minute about some changes to the legislation there around a portfolio exemption. So we'll come back to that in a moment. If we can move on to the next slide on the transparency regime, again, just a brief overview, a brief reminder for everybody. You can make this election where you're an offshore civ, where you're property rich, income tax transparent, and obviously there is a consent which must be gained from the investors. This election, you need to decide within the 12 months from when you start the property business, whether you're going to make the election or not. And once you've made it, it is irrevocable. What does it do? Well, it treats the collective investment vehicle as a transparent partnership. So in terms of the practical aspects of this, what do we need to think about? Well, first of all, it's a partnership. So we need to file partnership tax returns, and also the filing requirements and the tax paying requirement falls on the investors. So when you make a disposal, you need to be informing the investors of that disposal, managing and monitoring the basis, and letting the investors know, you know, what's happened. The important thing here to be aware of is that when we talk about disposals, we don't just mean sales of properties to third parties. You could have disposals in many other forms. For example, a lease premium could constitute a disposal for capital gains tax purposes. So being aware of what a disposal is, keeping track of that and being able to report that on a timely basis to the investors who are having to pay the tax is important. One more point on this slide, I've put at the bottom there, SB D12, Statement of Practice D12. Now, some of you may be aware of this, many perhaps blissfully not aware, but this is an important statement of practice because this governs the capital gains tax treatment for partnerships. As I've just said, these CIVs are treated as partnerships, so it may be applicable in the case of the transparency regime. It could also apply where you have a partnership which is sitting above a UK property rich fund. I'm not going to go into the details on exactly what this does because we'll probably be here for a lot longer than you want to be, but the things to remember are that this statement of practice can result in dry tax charges potentially arising to investors and also shifts in basis which perhaps don't necessarily wholly reflect the commercial reality. So one to be aware of, and we might just come back to that maybe in the Q&A later on. If we can move on to the next slide, which is the exemption regime, again, a brief reminder to what this is. You can make this selection if you're, again, an offshore CIV, or in this case, if you're a company owned by an LP or a coax. Again, you need to be UK property rich, but here we do have the other conditions, the GDO non-close conditions, so we either need to be genuinely diversely owned or non-close and meet the UK tax condition. The UK tax condition is where not more than 25% of your investors can be exempt on their gains as a result of a double tax treaty. This election you can make at any time, backdate for 1 year, and it is revocable. And this election, I'm sure you all know, treats the gains within the structure as exempt. And the tax arises when there's a distribution to the investors or when the investors sell or redeem their interest. Again, what practical things do we need to think about here? Well, we've got filings to do. We've got to provide information with the election up front about the funds, disposals, investors, and then annual filings to do as well. And there are also, because there are a number of conditions, there are a number of things that you need to monitor on an ongoing basis. And if we could just flick onto the next slide. If we're looking at conditions and considerations here, we have things like, for example, the fund status. If you're an offshore CIV, clearly you need to be not UK resident. UK property richness. This is obviously an important condition for these regimes. And you might think, well, that's obvious, you know, I've got a UK property, I'm clearly UK property rich. But actually there might be situations in which perhaps it's not so obvious. For example, where you've got some non-UK property in there, or maybe when you've got, you know, other things other than property within your structure, or perhaps where you've sold your property and you've got a load of cash waiting to either reinvest or distribute. So again, having something in place to manage and monitor the UK property richness of your structure is important. Clearly, you know, the GDO non-close UK tax conditions are important too, and a lot of that, certainly on the non-close and UK tax condition side, comes down to your investor base. You know, what is their status? Have you got the information about them? What happens when those investors change? And the next point, you know, capital distribution of exempt gains. This is around Para 21, and Wayne, again, will pick up on some changes to Para 21 in a moment. But very broadly, what this says is if you've made a disposal of an asset and that value is obviously distributed up through the structure to investors, that has to come out in a capital form at the top. If it doesn't, if it comes out as a revenue item, then potentially there's punitive consequences for your investors. So it's important that you can recognise that there's been a disposal, that cash is tracked up through the structure and comes out in that capital form at the top. Again, that goes back to that point I mentioned a few moments ago, which is that we're not just talking about disposals of assets to third parties here. It could be much, much broader than that. So being aware of those disposals and being able to track them is really important. We've also got, you know, the considerations for investors in terms of reporting, but also, you know, breaches and the impact on investors too. So I think in summary, there's a lot to think about with these regimes and a lot of, you know, potential monitoring and considerations to bear in mind when you're operating within them. So I'm going to pause there and just hand over actually to Wayne now, who's going to take us through some of the changes, recently announced changes to the legislation.
Thank you, Leonie. I did look at the list of attendees. I think I know quite a few of you, but for those who don't know me, I'm Wayne Strangwood. I'm the Policy and Technical Lead for Collective Investment Vehicles in HMRC's Financial Products and Services team. If we could have the next slide, please. So I'm going to talk about the regulations that were laid, I think on the 2nd, maybe the 3rd of March. They are due to take effect from the 24th of March, and they amend existing legislation in Schedule 5 AAA in TCGA, which are the rules that deal with funds or collective investment vehicles and their investors for NRCG purposes. Without repeating too much of the history, I'm sure you'll all know this anyway, there were some particular problems for funds in that we really didn't want exempt investors to be worse off by investing through a fund structure and tax being suffered within the fund, and naturally people were fairly keen there wasn't any element of double taxation as well. So Schedule 5 AAA is a part of the rules that provide the elections that Leonie has just described for exemption and transparency. We spent an awful lot of time speaking to industry before the original legislation was introduced. We continue to do that, and there was a first set of amending regulations last March. I hope this doesn't turn into an annual event, but we now have another set this year. The most significant change that those regulations introduce is a limited portfolio exemption, and I've apostrophed portfolio exemption because you won't find it referred to as such in the legislation, but I think that shorthand that people have adopted, and I'll say a bit more about that in a moment. Probably the most significant thing after that is some changes to the rules in paragraph 21 that Leonie has also very helpfully provided the background to, so that will save me going through that. And there are a few minor errors, most of which don't have any actual practical effect, but there is one regarding the definition of a sieve, and I'll quickly refer to that as well. Right, next slide, please. So the portfolio exemption, some brief background. Unlike many jurisdictions, the UK did not introduce a wide-ranging portfolio exemption when the rules taxing non-residents on UK real estate were introduced. Treasury decided that wasn't something that they wanted to do, and the changes made in the regulations do not change that basic starting provision. Instead, they deal with some issues which were brought to our attention after the introduction of the original legislation and too late for the March 2020 regulations. But essentially, non-resident life companies were having huge problems because they simply hadn't developed the systems in order to allow them to track, compute and file details of relevant disposals. And if anybody knows anything about the complicated way that we tax UK resident life companies, the practical effect would have given rise to a distortion, and as a practical matter, it simply wasn't possible for the industry to react quickly enough in order to introduce some very expensive bespoke systems similar to those used by UK companies. The other groups that we heard from were collective investment vehicles which had de minimis interests in UK property-rich SIVs, and that might typically be where you had, say, an index tracker, perhaps tracking the FTSE 100. Any one time there'd probably be, what, 3, 4, 5 UK REITs in that index, and tracking the index requires regular buying and selling, and that can add up to, you know, a huge number of transactions within a fairly short space of time, which leads to certainly what people were thinking was a disproportionate administrative burden. There are some other issues for other funds as well, and the outcome is that ministers agreed that we should introduce a limited portfolio exemption, and it applies to non-UK resident life companies, non-UK resident, non-UK property-rich SIVs. So they will not be within a potential charge to tax when they make a disposal of an interest in a UK property-rich SIV, provided they do not have an interest of 10% or more in that SIV immediately before the disposal. So it has to be below 10%. There are some conditions. Please look at the legislation and the explanatory memorandum, which will give more detail. We're expecting to publish updated guidance by the end of this month, so please keep an eye out for that as well. But in brief, life companies, the percentage of their total assets can't consist of more than 40% interests in UK land. So that's direct and indirect interests. For SIVs, they must meet the non-UK real estate condition. That's in Regulation 7.2a, I think, of Schedule 5 AAA. And the GDO, genuine diversity of ownership condition, or if they're a company, they must be non-close. And such SIVs cannot be a UK feeder vehicle immediately before the disposal, and that is defined by saying that at least 85% of the market value of the assets of that vehicle derive from units in a single collective investment vehicle that's UK property rich. And the reason for that is that this exemption is not really targeted at tax aggregators or feeder vehicles. It is for collective investment vehicles that may have you know, a wider spread of assets, perhaps as part of a balanced strategy, or a multi-jurisdictional real estate fund, where, you know, these will genuinely be de minimis interests, and it was not aimed at these types of UK feeder vehicles. Next slide, please. Paragraph 21, I'm not going to say very much about this. I think Leonie has set out the background very well. So the changes that are being made are to make it clearer, because we had quite a bit of feedback from rep bodies in particular that it wasn't particularly clear from the legislation as it stood, that a deemed disposal will not be treated as arising where the value in question has already been taxed on another person. So in practice, this means that there has been a disposal within the fund, and it might have been charged to tax as income, perhaps under the short lease rules or transaction in land rules, and that disposal might be an actual disposal of property. It could also refer to a disposal higher up the chain, where interest in a vehicle in the structure are redeemed in order to pass value back to shareholders. Regulation 8 is the part of the new regs that makes these changes. It also makes provision for cases where only part of that underlying value is charged to tax as income. And it does that by providing for a just and reasonable reduction of the market value. So this is for the investors who might be within charge to Para 21 on their deemed disposal, so that any gain is reduced. And that might happen, i.e. Only part is charged, again, perhaps under the transaction in land rules, as an example. Where we do have that sort of reduction in the market value, then Regulation 9 also amends paragraph 23, and paragraph 23 essentially deals with the timing of the charge of any gain calculated as a result of the deemed disposal in Para 21. Part of a charge can be deferred, and so the new rule will alter or potentially alter one of the parts of that calculation there. It can get a bit complex, so there's no point me really saying too much more about that, but you know, no doubt you've all started to look at that. Next slide, please. Okay, so I did forget to mention the definitional change, which is all to do with how the property income condition applies for one particular type of sieve. It just didn't work properly, and the regulations clarify how that works, so that it works as intended. Probably the other point to mention is that the relieving elements of the changes are effective from 6th of April 2019, so they have retrospective effects. Any other elements, particularly where there's a potential taxing effect, of course, only have effects, well, from the dates stated in the regulations, but certainly they don't have retrospective effect.
Thanks, Wayne, for that. That was really helpful and an interesting summary. So thank you. So it's time now for the Q&A panel discussion. As I said, if you've got any questions to ask, please do put them through the Q&A section of the. Hopefully, you can see that at the bottom of your screen. And actually, just to kick things off, I thought maybe we could sort of look at some of the practical aspects of the regime first of all, and maybe come back to some of the more detail around the new changes. But Wayne, you mentioned revised guidance coming out. Just to confirm, is that revised guidance in relation to just these changes, or are you looking at revising the guidance overall to take account of some of the comments that were previously fed through?
Yeah, it's going to be an update of the whole of the guidance. So at the moment we publish draft guidance under Appendix 15 and Appendix 16 headings in the capital gains manual. So the idea is to put that into the manual properly with revised numbering. There's quite a lot of tidying up. There are some changes to reflect comments and questions we've received. One thing we haven't really had time to do yet is to put in the many more examples that people would like to see, but we are speaking to our friends at the BPF and elsewhere to revisit that, and in due course we will update for that. But you know, in respect of these new regulations, it will provide a bit more sort of meat on the bones regarding the changes I've just explained.
Okay, well, we'll look forward to seeing that then. Thank you. And I guess, you know, generally, I mean, these regimes, obviously, transparency and exemption regime were very welcome when they were introduced. I mean, as we've outlined, implementing new regimes does bring its challenges in terms of monitoring and managing and thinking about what you need to do. And I guess, John, and turning to you, you know, what it would be really interesting for us on the call to hear actually what challenges and pitfalls you faced working within the industry when operating within the transparency and exemption regime. So can you just talk to us a little bit about those challenges and pitfalls?
Absolutely. I think the first challenge we really dealt with was one that I think came up, as you say, owing to the complexity of introducing new regimes, where we had, for example, a exemption elected fund, which above it had a fund which itself was not property rich, therefore couldn't elect. And beyond that, you had a collection of normally exempt investors who obviously scratched their heads and thought, well, hang on, you've created tax where no tax should exist by virtue of that intermediate fund. Credit to HMRC here, who took on board comments from industry to fix those issues. But that, when we talk about practicality, suddenly we had a collection of investors asking a lot of questions about why there was now tax in a structure that they'd been assured was a tax neutral structure in place. So there's a lot of investor relation aspect around that. That helpfully has of course been sorted. I think on the other side, in terms of practical operation going forward, it really is about the embedding of awareness of the regime and the implications throughout the whole commercial structure, i.e. this is not just a tax issue. You referred earlier to items that might be capital that people don't immediately think about. Well, now you have to find a methodology to identify and communicate those items. So I think, as I say, that we had a headline issue in relation to the regime, and then what we found from a practical perspective is really embedding it across the organisation.
Yeah, and I can see, that is a tricky thing where people have been used to doing things in one way, have to suddenly change. And Christopher, have you found similar things, or are there other pitfalls, challenges you faced?
Yeah, I mean, I think I agree completely with what John says. I think the other thing is obviously we need to be collecting more information about our investors than we did previously. I mean, usually that's not a problem in a sort of small fund, but in a very widely held fund, it can be quite a complex exercise. The other thing that we found is that, because, as you've mentioned, this point about disposals during the year, I think we were working, or our fund accounting teams were working generally in tax on a sort of annual cycle, and expecting that everything would be picked up in the year-end reporting. But there will be situations when a disposal triggers a filing obligation by investors within 30 days. And that obviously needs procedures that will pick those points up and make sure that investors are informed early enough to be able to take action and seek advice.
Yeah, and actually, as you've been speaking, a number of things have popped into my mind about the different points you've mentioned there, because there's quite a few different themes around, UK property richness, investors, managing and monitoring. So maybe we can pick up on some of those points actually. So Wayne, John mentioned being UK property rich or not being UK property rich. I guess this, as I've mentioned in my brief overview, can sometimes be a challenge where actually it's not completely clear. In some instances it is very clear. Can you just talk us through HMRC's approach to the question of whether an entity is UK property rich and how you would expect funds to manage this?
Yes, I'm not sure how much I can say about this, Leonie. The legislation 5AAA obviously draws on the core rules, and the core rules themselves are based on the starting point is what generally do our tax treaties permit us to tax. So we have this concept of UK property richness, which at the end of the day is a percentage level where you have to measure the value of some assets against the total assets of an entity. In a lot of cases that is going to be pretty clear. As you're pointing out, sometimes it's going to be less clear. I wouldn't want to speak for operational colleagues and tie their hands in any way, because I'm sort of a bit removed from the coalface, but I think, like with most things, hopefully, if HMRC are ever considering that question, then it's a case of taking, if customers have taken a reasonable approach in documenting their conclusions and the methodology looks sound and is applied consistently, then generally that's what we look for, whether it's this or any other instance of where a particular test or watermark needs to be considered.
Okay, thank you. That's helpful to know. And I guess some of the other things that came out of what you said, John and Christopher, one of them was around investors and the interaction with investors. And I guess what have you been, in terms of what investors have been saying, have they been raising kind of what kind of challenges, I guess, and questions have they been raising around the regimes? Have they been asking questions around them about, which particular options you have chosen, which regimes you've chosen to elect into, or perhaps what you've not chosen to do, actually, in some situations? What have you seen around that, John, that you could share with us?
We surprisingly, actually, we haven't seen huge amounts of questions, and I think part of that is a consequence of the fact that the different regimes are very well signposted, in my view. And I think the best signpost, to be honest, was around the unanimous consent requirement for one and not the other, which made it, I think, very clear, to be honest, and helped deliver a consensus in the advisory community about where you would typically go for one election or the other election. So it's very clear for a very widely held fund, realistically, you're only ever going to go for the exemption election. For single asset funds, for example, or smaller situations with 2 or 3 investors, then quite likely you might go for transparency. So I think that's really helped. So we didn't see that many questions around the decision-making process. What has been interesting is, some investors, I think it still took them by surprise that they were now a known party, if you like, by HMRC in some cases, where before they were not. And interestingly, with the movement from NRL, from income tax to the corporation tax basis, we've suddenly found we're getting questions to help people to calculate their QIPS payments. And that came as a slight surprise. It's obvious, I suppose, but it came as a slight surprise to us that is something that we're going to start seeing more of, I suspect.
Yeah, and that is quite a move, isn't it, in terms of the timing of that, as well as the calculation and how it operates. So you can see that could be a question they would have. And Christopher, how about you? Is it similar things, or have you had much interaction with investors on these topics?
Well, I think, obviously in the early stages, when there was a lot of uncertainty about the rules, there were some questions from investors. I think once things became a bit clearer, we tried to make sure that in all our funds reporting, in our annual and interim reporting, we made it clear what our intentions were. I think on one particular fund, we had a discussion with an investor who didn't understand why we would go with a transparency election because of all the complexities around SPD 12 and so on. But I think once they understood that the implication of an exemption election, which would have been available to them, wouldn't necessarily apply in the context of if that vehicle were eventually sold, and therefore there would have been effectively a triggering of a tax charge at the point of exiting the regime had they gone for the exemption regime, whereas the transparency rules work much more sensibly for that kind of vehicle.
Yeah, and you mentioned that you sort of mentioned making changes in documents as well, and I guess that's another sort of point which occurs to me is are there actually changes you've had to make to manage those regimes in terms of, again, the internal sort of communications? I know John touched on this earlier around kind of how you manage that internally, making sure you get the right information. So have you had to have new policies or procedures or training, or perhaps, as you say, changes to documents, e.g. fund documents, etc., to kind of deal with these regimes?
I mean, obviously, if we're setting up a new vehicle, we need to be very clear about how we're going to deal with the NRCGT aspects of it. So we will make sure that if we intend to follow, assuming we intend to follow one route or the other, we will record that in the prospectus and in the trust deed or partnership agreement as relevant for the fund. I think we also have to collect more information now about investors. So in terms of the exemption regime, we are required to provide information, if available, on existing funds in relation to the investors. But where it's a new fund, the expectation is that we provide the full information that HMRC require for those investors. So clearly we need to be ensuring that the documentation allows us to collect that information from the investors and that they keep us up to date on any changes.
Yeah, which again, I mean, it's a big change, isn't it, in terms of, the investors used to be sort of distant and passive, and we didn't necessarily need too much information about them. And suddenly, it's not just this topic, it's other tax topics as well. We need a lot more information to understand our tax position. And John, have you experienced the same sort of things?
Yeah, similar. Exactly as Chris says, some of your existing fund documentation clearly wouldn't anticipate the information requirements. Whereas for new funds, you can embed it into subscription forms, for example. The more interesting thing for us from a process perspective was, as we talked about before, making sure it was well socialized into the groups who could impact your ability to make sure you were compliant. As an example, we noticed with our finance colleagues that if you ask the question whether you ever make capital distributions, the answer is very clear no. If they ask the question of have you ever returned proceeds from sale or these types of transactions to investors, the answer is we might have done. So it was really important to make sure you accessed the different populations of people who actually impacted on your ability to comply, and through that making sure your process is appropriately catering for non-tax people, and the gathering of that information on the internal side.
Yeah, the questions are important in terms of how you phrase that, and that's good. Thanks. That's really interesting. Can we turn, Wayne? I'm going to ask you a slightly trickier question now, because I'm going to turn back to that comment I made earlier about SPD 12, which is something that is causing a headache to people. And I guess, as I said earlier, it's a statement of practice that clearly was introduced to manage partnerships, but it's now got this wider application because of NRCGT, and can create these direct tax charges and shifts in basis, and obviously the issues with from an investor perspective, which I outlined earlier. So I guess from an industry perspective, I suppose it would be really good for the industry if HMRC could look at SPD 12 in the context of real estate funds and structures. And I guess a general question to you, is that something that HMRC are amenable to doing, to actually, looking at SPD 12 and thinking about how it's now applied to these real estate fund and NRCGT contexts?
Yes, I've been cautioned by my capital gains colleagues as to what I might say about SPD 12. It's really not my area. I know for a fact that quite a few of the attendees showing on the panel on the right of my screen have been in touch with my CG colleagues to ask exactly this question. I think it's a difficult one, because if you polled 100 people with an interest in this, you certainly wouldn't get any unanimity on whether SPD 12 should be reviewed and possibly legislated, because it may well suit some people perfectly the way it is now, and obviously any review, you can't be certain of the outcome. So I think generally it's an area that hasn't been looked at. I think the OTS did look at it 4 or 5 years ago, and the conclusion at that time was that changes shouldn't be made. So I'm certainly not aware of anything in the offing. in an NRCG context, especially in a Schedule 5 AAA context, I think we've always been very clear with people, you need to think very carefully before making the transparency election. It was only really anticipated that that election would be used where you have, maybe one pension fund and perhaps a couple of taxable investors, and you want to protect the interest of the exempt investor, and making an exemption election isn't going to make anything too complicated for anybody. We certainly have seen elections where there have been quite a lot of participants in the funds, including chains of transparent entities. I think you're then potentially making life quite difficult for yourself, and you really have to go into that eyes wide open as to what the tax consequences are going to be. And as you say, SPD trial can be fairly difficult to navigate in practice.
Yeah, no, absolutely, and it's obviously been an issue that's been raised a number of times. I guess I'm conscious of time. We've only got a couple of minutes left. Just a couple of things on the portfolio exemption, actually, Wayne, if that's okay. Obviously, helpfully you've outlined how it covers offshore CIVs and insurance companies investing directly. There will presumably be a number of investors who won't benefit from the exemption, so still have filings and tax. And I guess I had just a couple of questions to ask here. So clearly some investors will benefit from treaty relief. So I guess it would be good for you to explain HMRC's position on whether filings are needed to claim that treaty relief. And secondly, is there any sort of possibility or discussion about opening up that conversation we were having previously about funds, filing on behalf of investors? Is there sort of appetite for opening up that discussion again?
Yeah, okay, I'll try to be brief on both those. Treaty claims, I think we communicated to rep bodies a few months ago that people did not need to file claims to treaty relief. So if there's a reasonable belief that particular treaty provision applies, then you do not need to claim that relief. That was done on a pragmatic basis, because I think otherwise, the industry and we would have to cope with who knows how many claims on an annual basis. The filing tax, or calculating the filing on behalf of investors in a CIV, a lot of you will know the background to this. It was something that we were certainly amenable to in the end. I think what thwarted it was potential cost of IT systems, shortness of time, other priorities, and I would hope as HMRC sort of move more towards making tax digital and wanting to ensure tax is collected at the right level and as accurately as possible, I would hope we can return to that, but there isn't any immediate prospects, I'm afraid.
Okay, understood. Well, thanks for that. I'm aware we're up against the hour now. Unfortunately, we do have a couple of questions, a few questions we haven't managed to respond to yet. Some about the practicalities actually of the regimes of filing and the systems that are used there. So I think the plan is that we will take those questions away and we'll try and respond to them, separately over the coming days. But just remains to say, thanks to the panelists for your very candid views. And as I said earlier, these regimes offer great opportunities for people, but you do need to manage and monitor them. But I think the great thing has been all the way through this has been so much collaboration with HMT and now HMRC on this process, as illustrated by Wayne joining us today. So it's been great, and that I'm sure will continue. So thanks to Wayne and to John and to Christopher for joining us and for giving your views and sharing those with us. Thanks everybody for joining and for submitting your questions. As I said, we will try and come back on those. Please do give us feedback, which is really important and always valuably received. And do check out the the events coming up on the AREF website over the next few months, and do join anything that interests you. As I said, this webinar will be, or the recording of this webinar will be sent around and shared with everybody probably tomorrow, I believe. So thanks again for joining, and have a good week, everyone.